Welcome back, guys. So in this particular session, what we'll be discussing about is Anouk, question number 22 from SPR's exam kit. Okay. So what we've been given in the question is that I'll just read out the question as well. So background information is Anouk is a public limited company with a reporting date of 31st December 20x1. 31st December 20x1. It has a covenants attached to some of the bank loan balances included within liabilities on its statements of financial position, right? So it has covenants attached to some of the bank loans included within liabilities on its statement of financial positions. Okay, the covenants create a legal obligation to repay the loan in full if Anouk's liabilities exceed a specified level. Okay, so what they might do is that try to reduce their liabilities, right? Otherwise, the covenants will be breached. So a new finance controller was appointed in January 20x2. So after the reporting date, and has discovered some reporting issues in relation to the year ended 31st December 20x1. Okay. So receivables factoring. On 31st December 20x1, Anouk sold some of its trade receivables to a debt factor. The factor advanced 20% of the 40 million receivables sold. Furthermore, amounts become payable to Anouk but are subjected to an imputed interest charge so that Anouk receives progressively less of the remaining balance the longer it takes the factor to recover the funds. Further amounts will become payable to Anouk but are subjected to an imputed interest charge. Okay, so there is interest charge as well, and progressively less of the remaining balance the longer it takes for the factor to recover the funds. The factor has full recourse to Anouk for 6-month period, after which Anouk has no further obligation and no rights to receive any further payments from the factor. No rights as well. So after 6 months it has been transferred, whatever the sum has been received, that will be paid to Anouk as well, but after that it won't be, right? So what's the next issue? The directors are concerned about the negative impact that any potential debt factoring arrangements may have on its loan covenants. As such, they have ordered the financial controller to treat the factoring arrangement in accordance with its legal form. So discuss the accounting and ethical implications of the above, right? So let's discuss about it. Receivables, right? As well. So when it is about factoring, it's receivables. Receivables is IFRS 9, right? IFRS 9 financial instruments suggests that the trade receivable should be derecognized from the financial statement when the following conditions are met. When it will be are met, right? When will it be removed is that when there are no further rights to receive cash the recs and rewards of of ownership have transferred have substantially transferred, okay, in substance, right? In case of Anouk, the factor has 6 months, right? The factor has full recourse. For a 6-month period. So Anouk still has recoverable. Yep, right. Risk is there, no? Anouk has the right to receive as payments from the right. Anouk has the right to receive cash payments from the factor which is dependent upon what were the condition. So 6-month time period, right? So it depends on the timeline, right? So it depends on the payment timing. Depends upon when and if the customer pay the factor, right? Therefore, Anouk still has the risks associated with slow payment by its customer or by their customer. So the receivables must not be derecognized on the financial statement on 31st December 2021, but it has already been published, right? Instead, the proceeds of how much did they receive? 20% of 40, right? So 8 million, 8 million, which is basically $14 million into 20%. liability, right? Legal form will understate the receivables and understate liabilities, which makes the entity likely to break covenants, right? That's what would happen. So this is what I can write right now. So after that there is B shares, right? So what is this about? So one of the Anouk subsidiaries, VNE, has two classes of shares, A and B. A shares carry voting powers. B shares are issued to meet regulatory requirements. Vienna shareholding agreement stipulates that minority B shareholders can exercise a put option every 3 years, which requires Anouk to buy their share, right? Can exercise, okay. The exercise price is the original cost paid by the shareholders, okay. So in Anouk's consolidated statement of financial position, B shares owned by minority shareholders are reported in equity as a non-controlling interest. Okay, how can that be? It seems like a debt. Okay. Can exercise a put option every 3 years, which requires Anouk to buy their shares. The exercise price is cost paid by the shareholders. Okay. Let's define debt and equity, right? IS 32 financial instruments. Presentation uses principal space definition of a financial liability and of equity. The key feature of it is that the issuer is obliged to deliver cash or to deliver either cash or financial asset to the holder, right? A contractual obligation may arise from a requirement pay the principal or interest or dividend, right? Talking about equity is an contract which evidences a residual interest in the entity's assets. Deducting all of its liabilities. A financial instrument is normally an equity if the instruments includes no contractual obligation, either cash or another financial asset. Another entity such as ordinary shares. There is no obligation to deliver cash or other financial asset, right? Whereas in case of there is obligation from requirement to pay the principal or interest or dividend, which can be in the form of cash or other financial asset to the holder, right? So in this case, what has happened? Is there obligation? We need to just figure that out. Every 3 years, right? Which requires Anouk to buy. So they have an obligation to buy their shares. Classify B share as non-controlling interest is incorrect has a clear contractual obligation to buy B shares, right? From the British shareholders under the agreement and does not have an unconditional right try to avoid delivering cash to seller obligation. Okay, so the main differentiating factor is this thing, okay, is no contractual obligation. This should be highlighted. This is the main differentiating factor between these two. Therefore, the minority shareholders B shares should be treated as financial liability in the consolidated financial statements. The current treatment of B shares understates liability and overstates equity. Alright, after this we have crane, right? So on 31st December 2001, Anouk signed a contract to use a crane for next 5 years. The supplier of the crane is permitted to substitute the crane for an alternative model during the period of use, and is required to do so if the crane develops a fault. Due to the size of the crane, the supplier would have to incur significant cost to substitute it. The contract states that owner can use the crane for any of construction activities it wishes. However, the contract also states that crane cannot be used if the wind speed exceeds this must pay fixed monthly rental for the use of the crane. No accounting entries in respect of this contract. Financial controller found this contract by accident and suspects that the directors had attempted to conceal it. So this, if it exceeds 14 kilometers, so 14 kilometers per second, right? So this is just a restriction on use, uh, just a restriction, just the scope of it, that's a bit of restriction, right, for the safety of the crane. So that's not a big deal. We can justify that, and then it incurs significant cost, right, to substitute it. That means it is unlikely to substitute it. I remember we did an example regarding the coffee shop in the airport. It's the same case. Whereas in that case, it did not incur any significant cost, whereas in this case, it incurs significant cost. So there is a disincentive, right? This acts as a incentive for substitution, right? So let's write it down as well. So this will be as per IFRS 16, right? Crane. Leases. says that a contract contains lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. A right to control, right? And then have control over the asset. Contract must give customer the right must give customer right throughout the period of use, right? Substantially all of the identified assets benefits. No one can actually, the economic benefits can be reaped and then it cannot be, they have a right that other can't reap the benefits, okay? And then the next thing is direct the identified assets use. Okay. Although the crane used by Anouk can be substituted, the supplier the high cost of substitution will act as disincentive. Therefore, can be concluded Anouk has the right to use identified assets over the contract period. Period, term, anything, whatever you want to say. And then basically that's one thing, right? Now let's talk about the wing thing as well. This one. So now we have established that they have a right to use assets, right? Identified assets is there, that's been identified. So let's talk about the restriction part. Has the right to direct the use of the crane was decides how the crane will be used. The restriction on operating during high winds the restriction on operating during high winds is the definition of scope within the contract. Within the contract rather than preventing Anouk from directing use, right? It does not stop it from directing its use, right? It's just change in scope. Therefore, control has been established as well, right? And direct the identified assets use. Therefore, Anouk has control over the crane. So what should we do? Pay a fixed monthly rental, right, for the use of thingy. Present value of payments to be made present value of the payments to be made must be recognized as lease liability and a corresponding lease liability, right? And then a right of use assets should also be recognized of same value plus and same value plus any direct cost. Anouk has made no entry, which means the assets and liabilities has been overstated. So what are the ethical issues? Current treatment all three current accounting treatment state owner's liabilities accountant as a professional is expected to not make isn't expected to make such mistakes. Accountants operate under ACCA's Code of Ethics and Conduct. director. Doing so will break the trust of the public or stakeholders towards the profession. It would seem likely that the directors have deliberately circumventing terms of governance, particularly as they have concealed from financial controller. Such action is a clear breach of integrity and objectivity as outlined in ACCA's Code of Ethics and Conduct. The financial controller should remind the directors their ethical responsibility and mention the importance of compliance with accounting standards. The liabilities have been accounting standards, right? The accountant should also inform the non-executive director and regarding this matter. All the conversations must be documented. If disagreements remain, remain owner should seek advice from ACCA line and may also need to consider resignation if no effective channel for internal reporting of concerns exists. If nothing works out, the resignation may be the only last option. Okay, so this is basically how we answer this kind of question. So next question we will be looking at is fill question number 23 as per SPR's exam kit. Okay, so if you have any questions until now or anything regarding SPR, please do comment down below. I'll definitely be looking forward to your comments and will be very happy to answer your questions. So feel free to comment, and yeah, I'll see you in the next question. Bye bye until then.